In this episode of Retiring Today, are you still working or are you retired?
Your investment strategies should be different during each phase of life.
We're talking about the difference between accumulation investing and retirement investing.
Investment goals, risks, and money management right now on Retiring Today. Welcome to Retiring Today. This episode is all about the working years versus the retirement years, how investing looks different and how your retirement plan should change. I'm here with Lauren Merkel. He's a certified financial planner. We've got Sean Honkamp. He is a CPA and an investment advisor. And Lauren, before we bring Sean in, set the stage for us. It's really important that your plan for retirement is different during the working years than it is, obviously, when you're retired.
Yeah, because think about the different phases of life that you have gone through already, or the phase of life that you're in. Your goals, your objectives, what you're trying to accomplish, the things that are top of mind for you are completely different than what they were 10 years ago. It might be completely different than what they're going to be 10 years from now. So your investment strategies, your retirement plan needs to be different. And so what we really focus on here is having a team approach. Because there's not one person, there's not one company that can really do everything so well. So we have a lot of different people on this team. We have 17 people on the team now, Molly.
Wow.
And it's to service the different phases of life that our clients are in. Now, Sean and I met not that long ago, and we talked for a long time about you joining the team and adding the different expertises that you have. And one of the things I really like about Sean is he is a certified public accountant. So not only is he an investment advisor, but he has a strong tax background. And when it comes to retirement planning, the tax planning component is so vital to make sure that you're maximizing the resources you've spent a lifetime saving. So Sean has brought a lot of expertise to the team that otherwise we didn't have.
Yeah, Sean, it's great to have you on the show today and let people get to know you a little bit. Take us a little bit in your CPA years, just tell us a little bit how you got into that and then how you made that transition into helping people retire.
Yeah, thank you guys. I'm excited to be a part of the team. So a little bit of background. I grew up on a dairy farm in eastern Iowa. From there, I went to college at Northern Iowa, graduated with a degree in accounting and got my CPA license. So spent my entire career really in a services type industry, a few years in public accounting, and then as a financial advisor, I've been doing this for about 6 years. And then like we talked about, Lauren, you and I met a while back and we've been talking, and as I got to know the firm and the holistic planning, comprehensive planning that you guys do, I was very interested in being able to be a part of that team.
And today, Sean, we are going to, as you know, make the distinction between the accumulation years and the retirement years, not only what you should be doing, but maybe the people that are helping you kind of get to those goals. Because when you're working, it sure looks a lot different than when you're retired. Now that you've come to the Merkel Retirement Planning Team, a team that just focuses on those retirement years, what differences do you kind of see in the types of advisors that they are and what we're doing here at Merkel Retirement Planning?
Yeah, we do see a big difference. I think we find that a majority of the advisors out there are the accumulation type advisors. They're out there looking for maybe helping those younger individuals focus on their investment strategy and help them reach their goals. It's a little bit more transactional based. I know what I've seen here at Merkel Retirement Planning is the focus is really more on developing that relationship and taking them all the way through a process.
Okay, so today, Lauren, we're going to focus on parts of a method that you've been doing this for 20 years, helping people retire, and you've really identified 5 key components that are things that need to be looked at, analyzed, and customized for each person in order to really help them reach their retirement goals. And today, we're going to focus on 2 of those components of the Merkel retirement method.
Yeah, when you transition from the working years to the retirement years, you still need income. So the income planning piece of it is absolutely vital to make sure you have the confidence to say to your employer, hey, I've been working now for 40 years, but I don't need a paycheck anymore because I have saved all these resources and I have Social Security and I might have a pension, and so now I'm gonna go live the rest of my life on everything that I've accumulated. That is a hard thing for a lot of people to do, and that's why the retirement planning piece is so important. The income piece is really what allows people that confidence to say goodbye and go have fun for the rest of their life on the resources that they have saved. And then we have the investment piece that we're going to talk about as well. So really today, of the 5 components, we're going to focus on the income and then the investment planning piece.
Okay guys, let's do a little Webster's Dictionary definition here. We've kind of alluded to it, but to make it very concrete for the viewers, Sean, first off, kind of define for us accumulation investing. You talked about the transactional nature of it. What else do we need to know to get a good handle on it?
Yeah, accumulation investing is really where we all start. You think about getting that first job out of college. Hopefully you've got that 401k or that qualified plan with that employer, and you start setting aside as much as you can, right? I mean, the biggest factor to having a secure retirement and having as much saved as possible when you hit that retirement door is simply about saving as much as you can, right? When we're young and the focus is accumulating, we've got a couple of friends on our side. Our friends is really the time. Our friends are the time, right? Putting the money in to begin with and then compounding.
And then Lauren, as we look at what exactly retirement investing is, how do you kind of define that for people?
Well, the retirement investing is very much multifaceted because there's so many different types of things that you're trying to accomplish in the retirement years. Number one is you want your investment portfolio to deliver an income for you. Not only do you want the portfolio to deliver an income right away at retirement, but also 15, 20 years down the road as well. So you have to invest in a way to deliver immediate income as well as deferred income down the road. We also have to invest, or you want to invest it to where you know where when the next recession happens, or on average recessions happen every 5.5 years, so you're probably going to live through many of them throughout the course of your retirement. You don't want to have to lose 50%, 40% of your life savings. In 2008, the last Great Recession, that's exactly what many retirees did. So you have to invest it for income, you have to invest it to protect, to make sure it's going to be there throughout the whole course of your retirement. And then you also have to invest it with an eye towards tax mitigation. Because whatever Uncle Sam takes, that's not money that you get, right? That's money that you lose. That's money that can hurt your spendable income. So it's very much a multifaceted approach, and you have to be much more intentional now with your investing than what you've ever had to before, because you don't have nearly as much time on your side as what you've ever had before.
Okay, one good way to maybe break this down is to compare and contrast. So we're going to take Kathy and Todd. Kathy's 63 years old. She's preparing for retirement. She's hoping to retire at 65 or maybe sooner if she can. And then we've got Todd. Todd's 39. He's Kathy's son. He's 25 years at least from retirement. So we're going to look at investing goals, risk and money management, and how they're different for these two phases of life. So Sean, how about first you talk to us about Todd, his investing goals, and how they're going to be different than Kathy's?
Yeah, Todd still being 39, he knows he has a long, several amount of years, long amount of time before he's going to be starting the distribution phase of any of those assets. I mean, we think back to the most recent correction or crisis that we've seen is 2008, right? And everybody remembers that. I don't think it matters how old you were. People remember the impact of 2008, right? So, but most people that weren't in distribution phase, while they remember it, it didn't change their investing strategy or philosophy. If they stayed true and stayed to the course, they didn't take money out of that. They remained steady and committed to their strategy. So I think as you're still in accumulation focus or stage, you're still worried about the contributions. You're trying to get as much money saved in there as possible, and then just let the market do what it's going to do. We know most years, 7 or 8 years out of every 10 years, the market's going to be positive. So we're investing with the belief that we know that money's going to grow.
Sure. And then Kathy, Lauren, she might be not as heavily invested in the market. Her investing goals are going to change.
Yeah, she's maybe not as heavily invested in the market, but how she invests is going to be determined by her retirement goals. How much income does she need right away? But also what's going on with the economy, because the economy is really strong right now. So she might want to be a little bit more heavily allocated towards the equity positions to take advantage of it while it's here. But if the economy changes, she might want to change that as well. Whatever she does, she really has to focus on what her immediate goals are, what her delayed goals are, and then how she wants that portfolio to be positioned. So what we have up here on the screen is a chart for you, just to give you an idea of what kind of impact gains make on your portfolio, what kind of impact losses make on your portfolio. So if in 1 year you receive 100% rate of return, which there's not too many portfolios that are designed for a 1 year 100% rate of return, but let's just say Kathy's going for it. So right. in 1 year she gets 100%. The next year, because she was still going for it, she lost 50%. Well, she's right back to even where she was.
Okay.
So if we put some numbers around that, some dollars, let's say it's $100,000, she gains 100%, that's $200,000. She loses 50%, she's right back to the same $100,000. So that's not getting her anywhere. In fact, it's even worse because now she's retired, and that's 2 full years that she's been in retirement, 2 years less that she has, and she's in the exact same position. But that's when she had 100% rate of return first. What happens if she retires and the next year we go through that recession and she loses half of her portfolio? So again, she has $100,000. She loses 50% of that. That puts her down to $50,000. And remember, she's retired. So she needs income 1 year into retirement. She lost half of her life savings. It will take her a full 100% rate of return just to get back to even. The problem is when you lose 50% of your life savings in retirement, there's not too many people that are going to stick with that strategy to take advantage of the next year when it rebounds. And that's exactly what we saw in 2008 and 2009 as well. So how you're positioned for investing in retirement, you have to again be much more intentional about how you're doing it, because these big sways, these big ups and downs can really create a portfolio experience that's not the most advantageous for you.
We'll continue the conversation about Kathy and Todd, the working years versus the retirement years, and your retirement plan when retiring today continues.
You've worked a lifetime to prepare for retirement, but getting organized can be overwhelming. Important decisions need to be made about Social Security, healthcare, and retirement income. Where do you begin? At our Journey to Retirement workshop, you'll learn how to maximize your Social Security benefits, choose your best healthcare options, and avoid losses during the next market correction. Spots for this workshop are limited. Call today or sign up online at merkelplan.com.
Because of the Secure Act, everything about retirement planning has changed. With the stretch provision eliminated, your beneficiaries could be subject to pay higher taxes on the legacy you leave behind. Attend our one-night-only retirement dinner seminar at Fleming's Prime Steakhouse to learn how these changes could impact your finances, your beneficiaries, and your retirement. Go to merkelplan.com to sign up today and learn how the Secure Act may affect you.
Welcome back to Retiring Today. We're breaking down the difference between the accumulation years and the retirement years and how you should think about investing. I'm here with Lauren Merkel. He's a certified financial planner. Sean Honkamp, he is a CPA and an investment advisor. You guys sit down with people every day. You talk about their retirement goals, and definitely their investment goals, the way they invest, Lauren, it changes as they get closer to retirement or they're in retirement. So we've got Kathy and Todd. Todd is still in the working years. He's 39, so he's in that accumulation phase. And now we've got Kathy. We've been talking about her. So I'm going to take you back just a second to the second segment. So if you need to rewind after I ask the question. So I was following the ride with Kathy, the 100% return, the 50% loss.
That was a big ride. That was a lot of ups and downs.
You know, you did good. I have a question. So if I was a viewer, I'm going, I don't want that to happen to me.
Right.
So what had Kathy done, or what decision had she made that was not a good decision, that those things were happening to her?
Well, and we were exaggerating those numbers a little bit because not too many people get 100% in 1 year, right? But we were just showing the dynamics of math. What happens if you have some big losses? Many people in the last recession in 08 lost 50% or more of their portfolio. So we're just trying to prove a point. Even if you have these outrageous gains, which very few people ever have, these realistic losses can really destroy a portfolio. And when you're in the retirement years now, you have to be a lot more careful about those big losses. So one of the strategies that we are implementing and have been implementing really for about the last 12 to 18 months or so is a strategy called taking profits. How cool does that sound?
I like taking profits.
It's time to take some profits,
Yes.
right? The market's been doing so well for so long. The way that you can actually realize some of those profits is take some of those profits off the table, put them in a place where you know when this recession happens, whether it's this year, next year, or 3 years from now, it's going to be in a safe place. You're not going to have to come out of your retirement. You're not going to have to postpone your retirement if you're not retired yet. It's in a safe place and you can use that money. You're not going to lose. But you still have a reasonable upside, okay? So we're not necessarily getting into the product right now. The product doesn't matter. There's a lot of different types of product you can use depending upon economic conditions. But taking profits, taking some off the table. And then when the recession happens, or when we get some of these corrections or bear markets, you can take some money from the safe side and put it back into the market and buy low. How many times have we been told the way to make money in the markets is buy low, sell high? It's just very few people ever sell high. They just ride the roller coaster. So this is a way that you can sell high on a piece of the portfolio, protect it, and then get it back into the market when we do go through these different corrections or bear markets. So it's just a way to make sure you're protected, but also a way that you can take advantage of this market volatility when it does happen.
Okay, so Sean, speaking of waiting out the ride, Todd is more in that position to do that. He's 39, he's in the accumulation year. So let's talk a little bit about his money management strategy. What should Todd be doing?
Yeah, again, as Todd, with being in the accumulation stage yet, there are just fewer things that he needs to be thinking about and worrying about. As we touched on before, the biggest contributor to whether Todd's going to be able to reach his goals and save as much as possible for retirement is simply putting the money in there, right? Regardless of the rate of return and the fees you might pay, the more you can save, the more you're going to have. To keep it simple, a very simple strategy. Save as much as you can, as soon as you can, for as long as you can.
And not necessarily save in the bank, though that could be a good strategy. Maybe invest in, if you're fortunate enough to have a company sponsored plan such as a 401k, or you even work in a position where you have IPRs or something where that's an automatic pension. Is an IRA something that somebody Todd's age should be looking at?
Yeah, there's a couple different strategies and tools you want to be looking at. I mean, first and foremost, the 401k, right? You can't beat free money. So if you're fortunate enough to have a qualified plan through your employer, you want to be doing at least the minimum that is required to get the full match. From there, you may be able to do more. I mean, if you've got a Roth option in your 401k, those are more and more common. Those have been around now for a little more than 10 or 12 years. I think 2006 was when the Roth 401k option first came out. So those have been around. They're more common. So if you have the Roth option in your 401k, that's certainly something you want to look at. So just to elaborate on that, I mean, the tax component of what you're doing as you're working in those accumulation stages, you want to be thinking a little bit about the tax standpoint. If we believe you're going to be paying lower taxes today, that might be the time we want to utilize the Roth options that you have available to you.
Because you will someday have to pay taxes when you get closer to Kathy's age, when you're thinking about turning some of that savings into spending. What does Kathy's money management strategy look like, Lauren?
Well, part of what Kathy's strategy is doing the tax diversification or creating tax diversification. And if Todd can get started with creating more tax diversification when he's younger, then it's going to be a lot easier when he's Kathy's age. Unfortunately, a lot of people in Kathy's phase of life have not had a lot of the same opportunities to create this type of diversification. So as opposed to focusing on the contributions, when you're retired, the 401k option goes away, Roth IRA contribution options go away, traditional IRA contribution options go away. So now it's more, instead of contributions, more conversions. And oftentimes the first full calendar year after someone retires represents a really opportune time for them to start taking money, converting money from their pre-tax accounts into Roth accounts. Now you have to be very strategic and careful about how you do that to make sure you don't pay too much tax on that conversion, because one of the downsides is you do have to pay tax when you take it from the pre-tax and move it to the Roth. But with taxes on sale today, for many, many people, it does represent a good opportunity to start shifting some money from the pre-tax to the Roth, which will help them as they need retirement income down the road, but can also help them with many legacy strategies they're trying to implement also.
As people are talking, we know that a lot of these sort of rules of thumb somehow prevail in society. You know, we have them for all facets of life, but on the financial side of things, we hear about the 4% rule, take 4% out of your portfolio every year. Allie was just talking about the 100% rule. You minus, what's the 100% rule, Lauren? It makes me laugh because it's a rule of thumb that you're like,
well, it's a rule of thumb. The way this works is you take 100 and you subtract your age.
All
so
right.
let's say you're 60. So you take 100 minus 60, that's 40. That's the percentage that you should have in equities.
And that's just kind of a belief system that's out there. But we know that no matter whether you're Todd or Kathy, these rules of thumb, Sean, are not great ways to think of your retirement plan.
Averages are great, but you know, when we're meeting with individuals, we don't care about averages. You really only care about one. You care about your plan, you care about your strategy and your results.
And especially when you're in Kathy's phase of life, your results, your specific results mean that much more. Because we use rules of thumb like the rule of 100, and Kathy may decide after she's done her retirement plan that what that result is still leaves her with a lot more risk. Also, that rule of 100 doesn't take into any consideration whatsoever of what state the markets are in or what state the economy is in. So again, it could leave her in a place where she's overexposed to the market volatility that could take place over the next 12 to 18 months, really minimizing the opportunities of a successful retirement. So there's a lot of different ways that she can go around trying to determine what is the best for her outside the rules of thumb. What we focus on early on in our process is we do a risk analysis to determine how much risk you're taking. So so our families know when this next recession happens or when the next market volatility really starts to spike, which we've already seen it start this year. When we see that happen, they have a good understanding of how their portfolio is going to react. So they can answer prior to the recession happening, is it too much risk for them? Is it not enough risk for them? Are they going to accomplish their goals short-term, long-term, or should we make some adjustments? But having that information, that knowledge of how much risk you're taking right now can only help you short-term and long-term.
We still have more to talk about when it comes to the retirement years versus the accumulation years, how to work smart, not harder. But first we want to answer a question. This is our Ask the Advisor segment. This one came to us from Pat in Pleasant Hill. Pat's got an annuity, and Pat says, how do I fit the variable annuity into my retirement income plan? Lauren and Sean will have an answer for Pat when Retiring Today continues.
You've worked a lifetime to prepare for retirement, but getting organized can be overwhelming. Important decisions need to be made about Social Security, healthcare, and retirement income. Where do you begin? At our Journey to Retirement workshop, you'll learn how to maximize your Social Security benefits, choose your best healthcare options, and avoid losses during the next market correction. Spots for this workshop are limited. Call today or sign up online at merkelplan.com.
Because of the Secure Act, everything about retirement planning has changed. With the stretch provision eliminated, your beneficiaries could be subject to pay higher taxes on the legacy you leave behind. Attend our one-night-only retirement dinner seminar at Fleming's Prime Steakhouse to learn how these changes could impact your finances, your beneficiaries, and your retirement. Go to merkelplan.com to sign up today and learn how the Secure Act may affect you.
Welcome back to Retiring Today. Before the break, we have this question. Here it is up on the screen again. Pat from Pleasant Hill wants to know, how do I fit my variable annuity into my retirement income plan? I'm here with Lauren Merkel and Sean Honkamp. They are two people who sit down every day with people and talk about retirement plans. So Sean, what would you tell Pat?
Pat, the first thing you want to start with is really just to review the purpose behind that variable annuity. We all end up with different financial products and tools. And we accumulate them over life, and then we get to retirement stage, and we want to make sure that they're still being used to achieve one of our goals. We see a lot of variable annuities that are high in cost, so we want to make sure to analyze your variable annuity, your specific situation, understand maybe what the fees are, and just make sure it is still in line and helping you achieve one of your financial goals.
So we've been comparing and contrasting the working years and the retirement years, how you invest, how you think about money management, how you think about risk. So let's talk about something we have on our outline here that says work smarter, not harder. So you've been talking about Todd, Sean, so I'll come back to you. Todd is in the working years. He's 39, so he's thinking about investing, and low cost investments are maybe something he should be looking for.
Yeah, thinking back to the 401k, which is the most common investment strategy that individuals in their accumulation years have. It's important to understand the lineup and the investment offering and options that you have in that 401k. The investment expense or the investment ratios of those options can vary quite a bit. So it is obviously to your advantage to look at and try to utilize those lower cost investment options.
Okay, so Kathy, how is she going to work smarter and not harder?
Well, there's a lot of different ways. Oftentimes we see people who have been retired for 5 to 6 years, and they have some of these legacy life insurance plans. And they're wondering, one of the big questions, do I still need to have this life insurance? Well, the retirement plan can identify, do you still need it? Or is that one area you can save some expense? Or if you have some cash value underneath the life insurance policy, what do you use that for? And then also this big question of long-term care. People at this phase of their life are really starting to question, how do they cover this long-term care risk? Because going out and buying long-term care insurance can be really expensive and just not quite a feasible option for many people. So make sure that the products are working for everything, and sometimes you can combine some investment products with covering some of the long-term care risk or just getting rid of things that you don't need, like life insurance.
So we've talked a little bit about income today. We've mentioned taxes. You talked just a little about long-term care. These are just 3 of the 5 components of retirement that we use from the Merkel Retirement Planning Team. We also talk about legacy. You talked about that a little bit, and also taxes, investments, healthcare, long-term care. My point being, there is a lot when it goes into retirement and a lot to learn. So an opportunity that we have are education classes. So Sean, tell us about the Journey to Retirement class. Who's a good candidate to maybe come to that class and learn about retirement?
Yeah, our Journey to Retirement class is meant for individuals within 10 years of retirement and beyond. It's a great opportunity. Our goal there is to educate. So we're going to try to help you as you think about the steps and the questions that you need to address as you move from that accumulation stage into that retirement stage. And while we're there, we certainly try to have a lot of fun and give you as much as we can.
And we also have the Boost Your Retirement class. Lauren, tell us a little bit about that one.
With the Boost, it's intended for those who are already retired. So you're already retired, you have some income going on, maybe you have a preliminary income strategy, but now how do you boost that income to really maximize the resources that you do have? And how do you boost your confidence level that you're not going to run out of income before you run out of time? And again, in this phase of people's lives, now they're starting to reconsider some of their legacy goals. Maybe the legacy goals they put into place 10 years ago are not quite what they want them to be now. Life has a way of changing, and our vision for our future has a way of changing as well. So we really want to go into some different legacy strategies that you can consider to make your legacy plan the most effective as possible. And the long-term care options, this is when people really start to get serious about what they should be concerned about from a long-term care standpoint, because they're starting to live it. Right? Whether it's through their parents or their friends, they've seen people go through long-term care and how expensive it really is. So now how's the best way to tackle that? We cover all of those plus a lot more in the Boost.
Okay, so Boost Your Retirement and Journey to Retirement. There's also a Women in Retirement course. Go to merkelplan.com. That website's on the screen right now. You can see the different classes, learn more about them, and see where one is in your area. They're free, and they're about 3 hours long, and they're just a really great opportunity to get started on your retirement journey or boost the journey that you have in retirement. A couple of other great ways to learn. We've got a podcast. It's called Retiring Today. You can get it wherever you get podcasts. It's kind of your on-the-go option where we really break down some of the timely topics in retirement planning, and we will continue to do episodes of this show. It's Retiring Today, and we thank you for watching.
Because of the Secure Act, everything about retirement planning has changed. With the stretch provision eliminated, your beneficiaries could be subject to pay higher taxes on the legacy you leave behind. Attend our one-night-only retirement dinner seminar at Fleming's Prime Steakhouse to learn how these changes could impact your finances, your beneficiaries, and your retirement. Go to merkelplan.com to sign up today and learn how the Secure Act may affect you.
You've worked a lifetime to prepare for retirement, but getting organized can be overwhelming. Where do you begin? At our Journey to Retirement workshop. Call today or sign up online at merkelplan.com.
From our family to yours, we hope you have a wonderful weekend.
We hope you enjoy the show.
We'll see you next week.